So just wanted to quickly talk about some recent news during the week. Some changes to the P.D.T rule or pattern day trading. And it's just a quick little article here from CNBC. Let me go ahead and switch over so you can check it out. Okay, as I had just said, so day trading is about to get easier for small retail investors. This is the article I was reading earlier. It's from CNBC, and it's basically some of the changes for people who are in the trading world, as we are options. I'm sure it's going to affect us because this PDT rule, the 25,000 minimum equity rule, it applies to traders who um, and buy and sell a position four times or more within 5 business days. I actually put this into Grok here, and I just asked it, explain to me what the PDT rule is in simple terms, and just highlighted here. Basically, if you buy and sell the same security like a stock on the same day four or more times within any 5 business days, you are labeled a pattern day trader. And once that happens, you must maintain at least $25,000 in equity in your account, which I have been labeled this, and it sucks because I actually can't. I actually have to maintain $25,000 or more on one of my accounts if I want to day trade, and yeah, sometimes I don't have that much, so I'm unable to do it. So I'm unable to day trade. Okay, so going back to this article here, let's see here. Go down here. I kind of highlighted this area here because it's kind of important. So basically, what is going to be replacing? Okay, replacing that rule. What's going to happen after that rule is done with? I'm just going to read here. FINRA is replacing the mandate with an intraday margin rule that applies the existing maintenance margin rule to intraday exposure. In other words, one's intraday buying power will be based on the margin requirements for the positions they take on during the day, not a fixed equity minimum. So, with what I just read there, it seems that they're replacing and going away with the old rule of maintaining that $25,000 minimum equity in your account. And basically, if you get into a zero DTE, let's say an iron condor, right, on SPX or something like that, and they're basically going to estimate the margin expansion that that position can expand, basically the risk, not the entire risk, but the margin expansion of that iron condor, for example. And that's going to be how they're going to sort of regulate this. That's sort of what I'm getting at from this article. I'm sure once this goes through, because it has to be approved by the SEC. If it goes through, I'm sure we're going to get more clarity. But that's what I'm coming away with this article. Basically, the margin expansion of a certain security for like a zero DTE, that's what they're going to base their risk assessment off of. So you could actually trade with like $5,000, $3,000, something much smaller. It doesn't have to be necessarily $25,000. But with that being said, I just wanted to share that with you guys, and I'll be posting more of this just option trading news if I run across it. So with that being said, I'll see you all soon.